Imagine waking up one morning, checking your stock portfolio, and seeing prices skyrocketing or crashing overnight. You wonder, what just happened? Well, chances are, the FOMC made a big decision. But what is the FOMC, and why does it have so much power over the economy, stocks, and even your bank account? Stay with me because, in the next few minutes, you'll understand exactly how the Federal Open Market Committee, FOMC, influences your financial future. And trust me, you don't want to miss this. What is the FOMC? The Federal Open Market Committee, FOMC, is one of the most powerful financial institutions in the world. It's a branch of the Federal Reserve responsible for making key decisions about interest rates and money supply in the United States. But why does this matter to you? Because when the FOMC makes a move, it impacts everything: the stock market, inflation, mortgage rates, and even how much you pay for groceries. Let's break it down in the simplest way possible. How does the FOMC affect the economy? The FOMC meets 8 times a year to discuss economic conditions and decide whether to raise, lower, or keep interest rates the same. Their decisions are based on factors like inflation, employment rates, and economic growth. 1. If the FOMC raises interest rates, borrowing money becomes more expensive. This slows down spending and investment, helping to control inflation. But it also makes loans, like home and car loans, pricier for everyday people. 2. If the FOMC lowers interest rates, borrowing money becomes cheaper. This boosts economic growth because businesses expand, people buy more homes, and stocks tend to rise. However, if rates stay too low for too long, inflation can get out of control. 3. If the FOMC keeps rates the same, they're waiting to see how the economy responds before making any major changes. Why does the stock market react so strongly? Whenever the FOMC makes an announcement, the stock market goes crazy. Why? Because investors try to predict how the Fed's decisions will impact the economy. When rates go up, investors worry about slower growth, and stock prices often drop. When rates go down, investors get excited, and stocks usually rise. If the FOMC's decision is unexpected, the market reacts even more wildly. This is why you often see headlines like "Stock market plunges after Fed meeting" or "Markets rally as Fed signals rate cuts." How does this affect you? Even if you're not an investor, FOMC decisions impact your life in many ways. Loan and mortgage rates. Higher interest rates mean higher monthly payments on homes, cars, and credit cards. Cost of living. If inflation is high, everyday items like food, gas, and rent become more expensive. Savings and investments. If rates go up, banks offer higher interest on savings accounts, which is good for savers but bad for borrowers. What to expect in the next FOMC meeting? The next FOMC meeting could bring big changes. Analysts are closely watching inflation data, job reports, and global economic trends to predict the Fed's next move. So, should you be worried or excited? That depends on what the Fed decides. But one thing is certain: the FOMC's decision will have a major impact on the financial world. Now that you understand the power of the FOMC, you're one step ahead of most people when it comes to financial knowledge. If you found this video helpful, make sure to like, share, and subscribe so you never miss important financial updates. And let me know in the comments, what do you think the Fed will do next? Raise rates, lower them, or keep them steady? Let's discuss.